Hello everybody, welcome to another video with your man Sifu Steve in TradingLive. So today I will be talking about fair value gap, the most elusive concept or idea out there at the moment, the most widely used as well. So I will try to keep it as short and simple as possible for your ease of understanding. Let's get started, alright? Without further ado, let's move to the first slide. What is fair value gap? Obviously, we start with the question, what is that thing? Fair value gap or FVG comes with many other names such as imbalance, inefficiency. There are specifics to fair value gap as well, which is some called SIBI or BISI. It's a categorization of the inefficiency. But to keep it simple, let's call it fair value gap. FVG, yeah, it's a short form for fair value gap. Definition. The definition is very broad. You can define it however way you want it, but by all means, this is not my concept. This belongs to ICT, Michael Huddleston, the founder of SMC, and the founder of Fair Value Gap. But from what I understand, is an area of price whereby price delivery has not been delivered efficiently. So, what do I mean by that? As you can see in this chart, I screenshot. There's a candle low, and the candle's high. In between this low and this high, we have the fair value gap. Okay, so what makes it inefficient? Where does price delivered inefficiently? If it's evident in front of our eyes in the charts, over here we can see in between this candle low and this candle's high, there's one candle down delivering sell side. Now my chart is green and white because I hate the color red. So the down candle, the down close candle are all white. The bearish candle, the bullish is green. Okay, so we have a down close candle, sell side delivery, bearish move, alright, repricing lower, whatever you call it, lower, and it just left over there, and there's a next candle open up. It does not go back up to meet this area, so there's like a little so-called gap, right? So this area is the fair value gap. Assuming we can't see this candle and onwards, we only see this is the last candle print at the moment. Let's assume that for now. Then we have a fair value gap created with this down move. So this price delivery on the sell side is deemed to be inefficient. So if it's inefficient, there will be some point in the future that price will gravitate towards it to balance it, to deliver buy side, and vice versa. If it's inefficiently delivering only buy side, it will return back to it to deliver sell side. Okay, so fair value gap, they are like magnets, they pull price. So as I mentioned just now, an area of price that is delivered inefficiently, sometime in the future, nobody knows when, it will go back to that area to deliver price efficiently. So that is why the magnet example or the magnet analogy here. So because it's in imbalance, again another word, inefficient, imbalance, all means the same thing. Price may revisit that area to deliver price efficiently. So when will it happen? No one knows, no certainties, but we can make several assumptions based on other SMC techniques that what is the likeliness of price revisiting that particular fair value gap to deliver price efficiently. Alright, how do we get to know what fair value gap will pull price? With the right narrative and context, it helps to choose the right fair value gap. Right, traders can find the proper fair value gap using the right context and narrative. In SMC, context and narrative is extremely important. Another example, right, from the same chart, we already know what's happening here. Okay, I don't need to repeat that. Now price, actually the next 2-3 candles, slight poke, and then away. Next, what happened is it traveled back into the fair value gap, going almost 50% point of the entire fair value gap range, 50%, and then what happens? Instant rejection. Okay, price rally into FVG, deliver buy side in the later time. So this is a 1 hour chart. So several hours later, it goes back there to deliver price efficiently, and then it's allowed to travel away. So this is the interpretation of price delivered efficiently at a later time. Fair value gaps acts as a magnet to pull price. Also, a magnet can pull and push, correct? So this is pulling and then pushing it away. So you can view fair value gap like a support and resistance, in essence, right, to help your understanding. If you ask many SMT traders, they may not agree, but I suppose it's transferable to the retail idea of support and resistance. Some call it the real support and resistance, order blocks, fair value gaps, PD arrays, things like that. So with the right narrative and context, it helps to choose the right fair value gap. Not all fair value gap that exist in the charts are able to do what it's supposed to do or what you think it's supposed to do. Okay, so these 2 points over here, just it's very important to take note because it exists everywhere, every time frame, weekly to hourly to 30-minute to 50-minute, it exists everywhere. For me personally, number one, I determine the context and the narratives first, where price is supposed to go to or where it's likely to go, what is the draw towards a certain liquidity, or will it reprice to a certain level of premium or discount. And then I will use higher time frame like weekly, daily, 4 hour to determine which fair value gap carries more weight, which FFVG will be utilized in a higher favor, okay, compared to low time frame. I prefer the higher time frame ones. So we see here, narrative, lower prices, seeking sell side liquidity, or seeking discount array. It can be any one of these in the higher time frame. The structure is bearish. If we go to H4 daily, it also will look bearish, right? This is H1. So the narrative is to seek lower prices, to seek sell side liquidity for smart money to buy to cover, right? Or to seek some kind of discount array for smart money to buy. Right? Smart money buy at discount, sell at premium. Now over here, this example, it immediately rejects over here from the first test on the FVG. This itself job is done. However, price return back again to touch one more time below the FVG. So you know this high will not be broken. So again, when we determine short-term high, short-term lows, or intermediate term highs and lows, we know this high will not be broken because it has already done its job. Small touch, and likely there's a news over here. 1, 2, 3, 4, 5, 6, 6 down candles. This is displacement. Smart money reaccumulation over here, and it distributes with displacement, with great energy and enthusiasm down, great volatility. So we know smart money involvement is here. So this makes that fair value gap relevant. So again, this is to show that the fair value gap does not hold, right? It was disrespected. So this is a so-called bullish fair value gap because the inefficiency is buy side. It is supposed to decline into it and then rally. Just the same as what happened here. This is a sell side inefficiency, bearish fair value gap. It's supposed to rally and decline. Intended role, its actual role is like that, right? Supposed to dip into it and go higher. But what happens here? Because the narrative is bearish, the structure is bearish on a high time frame, therefore it failed, right? It got broken through once over here, body close below it, sideways, again close below it, sideways, massive tank, break of structure, break of structure. So this fair value gap already failed to hold price to the upside. Now, another application of fair value gap is it can turn support to resistance or vice versa. So we can also use this level here to further confirm the bearishness or the narrative of low prices, whereby a bullish fair value gap cannot hold the price, broken to the downside, and it return back to that it will be resistance now. So that's another application of fair value gap. Support turn resistance. Fail to hold the price upside. Okay. I received many of these questions in TradingLive, my live session, that does the fair value gap needs to be filled completely to be considered as job done, or it's a confirmation? No. The straight answer is no. Fair value gaps can fill completely. Yes, it can fill partially, like 50% of the range can. Yes, possible. A quarter, possible. 3/4, possible. Just one touch on the line, on the bottom range, possible. Sometimes it pokes above and body close below and then it travels below. Very, very possible. So it's a very subjective question. It has no exact answer to it. And you just need to play by experience and visually see, using experience and also investing hours into the chart to detect how the fair value gap can play out in different narrative and context. So, as I mentioned already, right, no black and white way to determine how much of the fair value gap will be filled. It don't exist here. It can fill as how it does or how it likes. It's not up to not up to us. So from this example itself, right, we can see there's a small poke above and the body close below and it travels down. This is also valid. This is valid. Next, another new fair value gap form here, right? Small poke down. It's valid. 50% fill and instant reject is valid. One touch on the line is valid and then it travels down. All of this is valid. No wrong, right? There's no mistake over here. So what's the lesson here? When in trading, we trade in the gray. There's no black and white. There's no certainties. Put it simply, there's only probabilities. What is the probability of this fair value gap to hold? After this happens, what is the probability of this high gets violated? Right? Over here, you may sell here, you put a stop loss here. Very unlikely, very highly unlikely this high will get violated. Over here, once it travel down and return back, if you're selling somewhere over here, catching the highs, right, and you're putting the stop loss above this fair value gap, when it return again, when you see green candle, you may get afraid. Yeah, but with experience, you know that this high, this intermediate term high, it will not get violated because it already has done its job. So your stop loss over here above the fair value gap will be fairly safe. And when it retests, and if you have experience and you're a seasoned SMT trader, you can re-entry, add on to your position here for lower prices. Okay, that's just example, yeah. Not trade advice, not financial advice, just applying what I know. So again, in conclusion, support and resistance zones are a representation of fair value gap, or I should say a fair value gap can play a role of support and resistance. They are a zone, an area, a two price level, a range, call it whatever you want. To put it simply, it's an area, right? Price is fractal. Fair value gap exists everywhere. H1, H4, daily, weekly, 5-minute, 1-minute chart, it exists everywhere. So you must be very, very careful to choose the right fair value gap to assist you in your trading analysis. How to do that? One of the main ways, the key ways, is to determine high time frame, narrative, and context. What is the next draw on liquidity? Where is price likely to go to? With other concepts of SMC such as PD array, power of 3, time and price, using the midnight open to determine are you below the midnight open or above the midnight open, all those will play a role to help you to determine what is the proper fair value gap to use. So that is it for today. Thank you so much for your time. I appreciate it, and I will see you in the next video. Okay, take care guys, have a good day. Bye bye.